All right, guys. So let's continue with our mentorship. Sorry for the break for the last 2 days. We have been having serious network issues. You know, this is a 30 days mentorship, and you know, from where I stay, I've been having some network problems. For me to come on this call, I need my network to be intact. To be able to host these calls on a daily basis. So for the past 2 days, network has really been fluctuating, and there's nothing I could really do about it. Right. So that is basically. So we're going to continue from where we stopped. The way I see it, this mentorship might push into November. Right. So we don't want to be in a hurry because my plan was to make sure that these sessions end on the last day of October. But the way I see it, it might push into November because now we are 2 days behind, and I do not want to be, making double sessions for a day, right? So maybe I'll see what to do. Either we push to November, or there are some days where we will have two sessions, morning and evening sessions, so we can cover up, right? So that's what I'm looking at. Either we do two sessions or we'll push to November, right? So today is let me check what day we are in. And if you have not gone through the previous videos, just go through those videos so that you can be on the same page, right? So you can be on the same page. So let me just check the day we are in. Right. I think we are currently we're in the 18, right? So we're in the 18. So we still have about 12 more days to go. So I think that possibly the coming days we might make them two so that we'll finish on 30th, right? So we might have double sessions for like 3 days, right? So we can meet up with the deadline, which is we don't I was thinking that maybe we wouldn't go into a new day, right? Into a new month. But the way I see it, we might have to have double sessions, right? After the sessions are highest 30 minutes, so there's nothing wrong with having two sessions in a day. Maybe we'll have one by maybe 8 a.m. in the morning and then one in the evening by 8 p.m. so that we can meet up with the date. So today is day 18. We're supposed to be in day 21. So we have 19, 20, 21. So we're supposed to have like three sessions which we are behind, right? So we might have you know double sessions in the coming days. So just put that at the back of your mind. So in case we have double sessions, I'll let you guys know to be do two sessions, morning and evening, morning and evening, morning and evening. All right. So today we're going to talk about interest rates differentials, right? So what is the importance of interest rates, right? Interest rates, right? Now it's a very, very interesting topic because interest rate is something that really, really determines the market direction on the long term, right? That means if you're a trader, you can use interest rates to determine the strength of a currency. Now, what's the importance of interest rates? Now, let us assume that you're an investor, right? Imagine that you're an investor and you have, let's say, $1 million, right? You have $1 million to invest, right? And now you meet two banks. You meet the European bank, and then you meet what's the Swiss bank, which is Chef. Now, the European bank tells you that okay, if you invest in our European currency, we're going to give you 10% per annum, right? That's per year, right? We'll give you 10% per year. And then you say, okay, okay, let me go and check my choices. And then you come to another bank and they tell you that the interest rate is going to be what? 23% per year, right? So now, if you are an investor and you meet the European bank and they tell you that they'll give you 10% per year, and then Chef, the Swiss bank, tells you that they'll give you 23% per annum. Which currency will you invest in? Obviously, be going for what? The one with the higher returns, right? Obviously, you're going to go for the one with the higher return, which is what? The Swiss bank, right? So this is how interest rate works. The interest rate helps us to know the strength of a currency, right? How much are the banks willing to offer to invest in their currency, right? If I buy Chef, how much is the bank willing to give me? Right? How much is the bank willing to give me if I buy Chef? How much is the bank willing to give me if I buy Euro or GBP and all that, right? That is basically what interest rate is. How much the bank is willing to give you when you invest in their currency? How much is the bank of that country willing to give you if you invest in that particular currency? That is what we talk about when we refer to what interest rates. Now, what is the importance of interest rates? Interest rates helps you to know the strength of a currency, right? And it helps us to know which currency would have strength, which currency investors are more likely to invest in, right? So now, that being said, now we'll now talk about interest rate differential. This is what concerns us as traders. We are focused on what the differentials, right? Right, differential. So now, interest rate differential. Now, for interest rate differential, we're looking at the difference between the two interest rates. Now, for instance, now we have looked at euro and chef. Euro has what? 10%, chef has 23%. That means chef is what stronger. That simply means that if you are trading a pair, this is just, I'm not saying that euro is 10%. I'm just giving you guys an example, please. I didn't say euro is 10%. For someone who said that I made a mistake, I didn't make a mistake. I'm just giving an example. I didn't say that euro is 10%. And I did not also say that chef is 20%. This is just an example, right? It's not like the real interest rate. It's not the real one, right? So now, if you're trading a pair like Euro Chef and there's a difference between these two pairs, this simply means that Euro Chef is likely to be what? Bearish, right? Because if you compare the two interest rates, Euro Chef is bound to be what? Bearish, because the interest rate of the base currency is lower than the interest rate of what? The quote currency. So now let us do the math. If the base currency, which is the first currency, if the base currency has a lower interest rate, right? So if the base currency, my God, so if the base currency, right, has a lower interest rate, right, you likely see what? An overall bearish market, right? Although I'm not saying it's going to be continuously bearish, it's overall bearish, right? If the base currency has a higher interest rate, right, the the currency is bound to be what? Overall bullish, right? So that's what I mean. So if the base currency has a relatively lower interest rate, right? A relatively lower interest rate, right? You're bound to see the market to be what? Bullish. I mean bearish. Why if the base currency is higher interest rates overall, you overall see the bullish market. Now, base currencies was the first one here. When you see Euro Chef, the base currency was the first one, while the quote currency was the second one, right? So that is what you have at the back of your mind. So base currency always was the first one, while why quote currency is what? The second one, right? The second one is the quote currency, right? So that is it. So always pay attention to the interest rate of the base currency versus the quote currency. So base currency, it determines which one, whether it's going to be overall bearish or overall bullish. So now let's also do another example now. Let's look at real examples now. So for you to get interest rates, you simply go to a site called globalinterestrates.com, right? So this is the site globalrates.com, right? Global/rates, right? You can simply just see it. That is the site. Control C. Let me also type it out so you guys can see it. That is the site to check interest rates, right? Globalc.com. All right, so this is a site. Global rates. Global dash rates.com. The last slash is not compulsory. Right? This is set for checking your interest rates, right? So that is basically how it's set for that. So now let us do a little maths, right? Let's do a little math. Let's look at a pair. Let's look at a pair like let's look at GBP. Let's look at GBP AUD. Right, let's look at GBP AUD. We're going to compare the interest rate and we'll determine which one will actually be what we expect for AUD and GBP. So we're going to look at the interest rates now. And must put the slash and then the slash. So let's look at the interest rate now for GBP. All right, so GBP is the British pound. British pound, the interest rate is current one is 5%. Previous was 5.25. So I think there was a change on the 8th of January. That was when they had their last change in interest rate. So currently the interest rate is 5%, right? So we can write that down. 5% is the current interest rate. So we can write it down there. 5%. Right. So now for Australian dollar, their interest rate is what? 4.35. It was 11. It's okay. They moved it last year. So the previous one was 4.1. So they currently moved to 4.35. Right. That means relatively Australian went up. It moved from 410 to 435. That's upward movement. While British pounds moved from, so it kind of dropped. But relatively, the interest rate of British is still higher than what Australian dollar. So if that being said, that means we have a 4.35%. Now, remember what I told you guys. Look at the base and post currency, right? What do you think? You're correct. What I think is that GBP AUD, since the base currency is higher than the quote currency, we would likely see what a bullish market overall, right? I said bullish overall. I didn't say it's concerned with bullish because if market is bullish overall, you're going to see what there can still be what bearish retracement, right? There can still be you can still see bearish retracement. Notice this in a bullish market, you can always see bearish retracement, right? So it doesn't mean that you will not see sell trades. Right, but the overall market, if you're a long-term trader, you're trying to swing or catch a long-term move, right? You're going to likely see what the markets go. So let's check out the pair GBP AUD. Let's use forex.com. All right. So let's look at the daily charts. All right. So this is the daily charts. Let's zoom out. So if you zoom out, you can see that overall, right? This guy has been bullish overall, right? This guy has been bullish overall. The last change was of British was in what? The last change was what in January. Why this one was okay? So let's look at from January. So pay attention from January. So we'll look at from January this year. So that was the last time I had a change in bullish interest rates. So you can see this January. That was last time I had a change in interest rates. Right, somewhere around there. So can you see that from that point, you can see the market has been overall bullish. You can see that market still drop retracement. We can see that market. So if you are a swing trader and you want to catch this trade, you have been targeting this high to take profits because the market is overall bullish. So the market is overall bullish. That means what? You were targeting previous highs. So if you are an investor or you're a swing trader, maybe after the market gave this bullish break, and then maybe you have taken your trade, gotten the discount level, which is what 50%. Market gave a discount level, came back here. Maybe I've been buying inside there, right? If you bought there, targeting what this high, if you're a swing trader, to be your first take profit, and then overall what this TP here, so that you can see how these things pan out, right? So that is basically a very good example. So let's look at another one. My God, this is a very interesting call. All right, so let's look at another one. Let's look at another pair. Let's look at something different. Let's look at another pair. Let's look at something that has a very far different. Let's look at okay, let's look at wow. Let's look at USD. Let's look at USD. All right, let's look at USD. Let's just see what the interest rate has been doing. Let's look at USD. So USD, which is what South African rand. So we're going to put USD interest rate first, since it's the base currency, and then the South African currency next. So we're going to just get the interest rate and then know what to expect on the overall chart. All right. I'm doing this so that they can understand what I'm doing, right? All right. So let's just so ZA. Sorry, sometimes it's just difficult to type on like this. Market can just be messing up. All right, so let's do this. So let us take this out as well. All right. So now for USD, the interest rate for USD is what American Bank. So American should be here. American Bank is 5%. Okay. The last time they moved it was on the month of September, right? So it moved from 5.5 to, so it dropped a bit. right? So interest rate for this is 5%, right? This is 5%, and the interest rate for ZAR is South African rand, which is South Africa, yeah, 8%. So it moved last month to from 8.25 to 8%. So 8%. Now, if since we have determined that the base currency USD has a lower interest rate, that means this market will be overall bearish, right? Right. So now let's also look at the chart to confirm if you are correct. USD, I don't trade USD, so I don't really trade this. Let us look at the market from this. So the market is overall bearish based on interest rates. All right. So can you see what I'm talking about? So if you're a swing trader, you want to always be checking your interest rates. Right. The market is overall bearish. This was a low you have been targeting. So if you are selling this market, maybe you caught a selling anywhere. Maybe as markets came back here, maybe you caught a sell. Anywhere you caught a sell inside the holding and targeting was this low. These are really the low you have been targeting, right? So you can see how market was overall was bearish, right? So we are not been selling and targeting this low, right? So that is the power of interest rates, right? You can see that. All right. So that is the power of interest rates. You just have to know the overall direction of the currency pairs that you're trading, right? This is a very, very interesting topic, right? All right, so that is it. So we're going to look at one last pair. All right, so let's look at Euro Chef. Right, let's look at Euro Chef. All right, so Euro Chef is going to be the last pair we look at. So we've already determined that Euro. We're going to determine Euro. Sorry, let's look at Euro GPY. Sorry, Euro GPY. So we've determined that Euro. We have to determine Euro currency rate and the JPY interest rates, right? So let's look at it. So for Euro, 3.4%. So rather than, and not only you want to see 3 points what 3.4%. Okay, last change in this month October. That was yesterday, sir, or 2 days ago. 3.4%. All right. So and then GPY, the interest of Japanese yen is Japan 0.25. Okay, changed in July 0.25%. Very low. These guys, they don't favor investors. Right. So if the base currency is higher than what the core currency, that means this market should be overall bullish. That means if you're swinging, you already know what to do. Right. You're targeting previous highs for your buys. Just buy and look for recent highs. So let's go USHF. So Euro JPY. I don't know why I'm saying Euro HF. So let's look at Euro JPY. So what do we agree? Overall bullish, right? So let's look at it. So you can see that market has been overall bullish. I told you that you can see bearish retracement. You can see that from this point, market has been overall bullish, right? Because the last time that Japanese yen changed was in July, and the previous time was 0.1. You can see it's very, very low, right? But we're not seeing a retracement, right? Because of course, interest rate is not the only thing that controls market movement, right? They also have other things too, like inflation, unemployment data and all of those things. So it's not only interest rates, right? Interest rates help us to know what direction the market should go towards. So if you are buying this, if you got a buy here, you're targeting this high. If you bought inside here, targeting this high. But the reason the market dumps is because we have already taken out all the highs we were targeting. So we already took out this all-time high here. So if you already saw that market took out this all-time high, so you've got to see your bullish target already. So I think that the best time we have been when market was down here, when markets came into this, bullish order block here, that was the best time to buy this market, bought into this previous high, right? So you can see market actually made a new high and then a retracement, right? So we can still see the market go bullish. Now, if the market should resume bullishness, that means we're targeting what this high, right? So now I can see the market. If the market can resume its bullishness, right, we can target a high. That means we want to see the market take out this high first. That means the market should break this recent high, and then we give us a retest to go higher, right? So this is what I like to see. We want to see the market break a high first before we confirm that one guy wants to go bullish. So let's say for if price can go above this high, that means market is ready to continue its bullishness. So for now, the market is not really ready for any consolidation. Market is consolidating for now, right? So nothing really juicy at the moment, right? So that is basically it. So that is how to determine interest rates, right? Of course, let me also state this. Interest rate is not the only determinant. So we also have other fundamental determinants, right? It's not only interest rate, right? Interest rate is just one of the things that move price, right? It's not the only thing. So sometimes market can drop even when interest rate it suggests bullishness because of other factors, maybe unemployment data, you know, CPI, which is inflation and other policies, right, that might impact price, right? So that is basically how it's done. So this is for interest rate differentials. I will see you guys in the next class. Have a wonderful day. Cheers and God bless.